Hey folks, welcome back to the channel. This is Jason, host of Fighting Words Financial. I wanted to talk to you a little bit more about the economic fallout regarding Russia's invasion of Ukraine. And I'm going to once again avoid most of the politics that I can, avoid talking about the conflict directly or the very real human cost. And I want to focus on the economic effects for the rest of the world here. And one of those big follow-on effects here is coming up here pretty soon. And that's the fact that Russia is likely to default on debts. Now, when I made my original prediction at the beginning of the conflict that this conflict was going to cause the economic collapse of Russia, my original vision of that was a few months in the future. I think that is probably coming quite a bit more quickly than I first envisioned. And I think that a Russian default on debt is only days away at this point. And let's talk about why that is. And let's talk about why it's not the big disaster for the world economy that we might think of. Like when Goldman Sachs and Lehman Brothers almost went out of business back in 2008. Lehman Brothers going out of business nearly took out the entire financial world. This is not going to happen with a Russian default on debt, and let's talk a little bit about why that is here, okay? So, what Russia debt default would mean for financial markets as Ukraine invasion continues. For foreign investors, a default is largely priced in, and I believe that to be true. So the threat of a Russian default on sovereign debt is seen as near, but investors so far aren't panicking over any potential hit to global financial markets. While the default would be symbolic, it seems unlikely that it would have significant ramifications both in Russia and elsewhere. That's a statement that I disagree with. It's going to have more ramifications in Russia than elsewhere, largely because Russia's probably going to be locked out of international financial markets for the next decade or so, even if every Russian soldier went home today. William Jackson, chief emerging markets and an economist at Capital Economics, wrote this in a note on Monday. So talk of a Russian default, however, stirs memories of past turmoil. In August of 1998, Russia devalued the ruble, defaulted on domestic debt, and declared a moratorium on paying to foreign creditors. The resulting crisis sent tremors through financial markets, resulting in the collapse and subsequent rescue of hedge fund long-term capital market. Now, we don't seem to have quite as many companies that are as heavily invested in Russian debt as was in 1998. After 1998, of course, this was seen as a much larger risk. Now, that's not saying that there isn't a single company out there that doesn't have significant investments in Russian assets and may see some degree of trouble. But the idea that a really large firm like Long-Term Capital Markets is out there doing something like that is pretty out there. That wouldn't be happening in today's market. They're significantly more cautious about investing in emerging market debt, particularly in Russian debt after 1998. So the International Monetary Fund director, Kristalina Georgieva, said on Sunday Western sanctions in response to the February 24th invasion of Ukraine would hit Russia hard, shrinking Russians' real incomes and purchasing power. And she warned that a Russian default can be no longer thought of as an improbable event. Georgieva, which that's an understatement. They're going to default probably as soon as Wednesday. Okay. Georgieva, in an interview with CBS's News Face the Nation, noted that while Russia has the money to service its debt, sweeping sanctions against the nation's financial institutions and central bank means that it can no longer access it. Rating firms have sharply downgraded Russian debt, with Fitch last week warning of an imminent default as a result of sanctions. But Georgieva said that while foreign exposure to Russia's banking sector at $120 billion wasn't negligible, it is definitely not systematically relevant, meaning that the default of Russians on what they owe in that case is probably not enough to bring the system down, as long as no major player like a Goldman Sachs or like Lehman Brothers was back in 2008 was threatened by those defaults. Moscow is scheduled to make around $117 million in combined interest payments on two dollar-denominated bonds on Wednesday, according to news reports. Russia's finance ministry on Monday said that it was prepared to make the payments, but may do so in rubles if unable to access the currency of the issue, according to Reuters. This basically means, folks, that they are in default. Reports noted that neither bond allows for payments in another currency. Failure to make payment in dollars could see Russia in technical default after a 30-day grace period. Look, nobody wants rubles because they're going to make those coupon payments in rubles, and then the next step is they're going to devalue the ruble. This is what they did in 1998. The biggest potential cost to Russia from default is being locked out of global capital markets, or at least facing higher borrowing costs for a prolonged period. Like I said, that's probably going to last for a decade or more, but sanctions have done that anyway. For foreign investors, a default is largely priced in, the Economist wrote, noting that Russia's sovereign dollar bonds are already trading at 20 cents on the dollar. If you look at this chart though, 20 cents on the dollar actually doesn't tell the whole story. Back in 2020 and 2021, if you look, Russia's dollar-denominated bonds were trading at almost a 40-cent premium over their issuing price, and now they're at 20 cents on the dollar. So the drop is actually quite a bit more precipitous than that. It's actually worse than what this article is suggesting when you take a look at the graph, okay? So news reports also suggest that creditors have already marked down their holdings, meaning that creditors have already written these off as a loss. They're saying they're not getting their money back, and they're already taking it off their balance sheets. And according to Georgieva's assertion, Russian debt is not systematically relevant. Jackson noted that the overall size of the Russian foreign currency sovereign debt held by non-residents is relatively small, at around 20 billion. And even if the government halts payments to foreign investors on all holdings of sovereign debt, local and foreign, the total is about 70 billion, is no larger than the debt Argentina defaulted on in 2020 without causing major tremors in global markets. I don't know if you guys knew this or not, but Argentina did default on bonds in 2020, and it didn't cause that much of a disturbance, probably because it happened right in the middle of what was already a bad time in COVID, but most people don't even remember that. Equity markets have, of course, been volatile in the wake of the invasion, but the threat of the default hasn't been flagged as a major source of worry for investors. And I think that's because not many institutions have a great deal of Russian debt in their portfolio because of the threat of political risk. That political risk was always there since 1998. U.S. stocks are mostly lower on Monday, extending the weak lines, yada, yada, yada here. Let's move on here. Jackson flagged two risks. First, there's the possibility that underneath the aggregate numbers, a systematically important institution is heavily exposed to Russian debt. And that would be someone like a Goldman Sachs or Lehman Brothers or Morgan Stanley. They have an abnormal amount of Russian debt and are potentially exposed. And if they're exposed, that might send tremors through the financial system. Right now, I can't find anyone suggesting that that is actually true. I can't find any other articles that are written on this suggesting that is true. So I'm thinking that's probably not as big of an issue, although there were a few close things. It looked like Kentucky's retirement system was heavily invested in a couple of Russian banks and pulled out of their investments in January and February. Second, a sovereign debt default could be a prelude to defaults by Russians' corporates, meaning their corporate bonds. I think that's could be a prelude. I think it absolutely is. Those external debts are much larger than the government's. And if you look at this chart here, the corporate debt is somewhere north of $300 billion. And I think that's a much bigger risk to the economy. But I think, once again, that's already priced in as well. Even though so far Russian corporations have been servicing their debt since sanctions were tightened. They've been doing that in dollars like they're expected to. But with trade being disrupted and sanctions potentially being widened and the economy is set for a deep recession, I think that corporations defaulting on their debts is likely, Russian corporations. So anyway, that is the situation here at this point. I think that we may see the first default on Russian debt as soon as Wednesday. And if that happens, there may be a short, sharp reaction to that, but I don't think that the market will hold on to that memory for very long. I think it's fairly obvious right now that Russia as a country is going to be locked out of financial markets for a decade or more, even if they come back, partially because this would be the second time in a generation that they defaulted on debt. And if they go ahead and revalue the ruble, that would be the second time in a generation that they've revalued the ruble as well. It's an economic disaster at this point, which, like I said, that was utterly predictable at the start of this conflict. They just didn't have the economic power or juice to pull this off. Anyway, those are my thoughts for today. Let me know what you think in the comments below. I am going to be covering some other subjects like SoFi and a couple of other fintechs that are really beaten up right now and I think represent some great opportunities. Anyway, look forward to hearing from you, and I'll see you next time.